The United States maintains trade relationships with many countries, but only a few are viewed by markets as consistently stable. Canada has long been one of those partners. This stability has historically supported investor confidence and predictable economic planning. When tensions emerged around this relationship, markets responded quickly. Rather than treating it as a routine policy disagreement, investors reassessed risk exposure. Stock prices declined, volatility increased, and capital flows became more cautious. The concern was not limited to trade measures themselves, but to the broader uncertainty surrounding policy direction. Economic confidence relies heavily on predictability, and when signals become unclear, markets adjust defensively. At that point, market behavior reflected a reassessment of overall policy stability rather than a judgment on any single agreement. The shift highlighted how sensitive financial systems are to changes in perceived consistency at the leadership level. Part 2. Different approaches to economic power. This situation reflects differing approaches to economic and political decision-making. One approach emphasizes assertive negotiation and direct pressure as tools for achieving outcomes. Another prioritizes credibility, institutional continuity, and long-term economic structures. Canada's leadership, with guidance from Mark Carney, has traditionally focused on maintaining market confidence through clear communication and system-based policies. This approach relies on supply chains, capital flows, and established agreements rather than short-term leverage. Financial markets tend to respond more favorably to clarity and predictability, particularly during periods of stress. When contrasting approaches interact, markets often gravitate toward the one that reduces uncertainty. In this case, investors appeared to favor signals associated with stability and rule-based processes. The response was less about personalities and more about which framework aligned better with how financial systems function under pressure. Part 3. Strategic Assumptions and Economic Interdependence. A key factor in this episode was the assumption that economic pressure would produce quick results. However, the United States and Canada operate within deeply integrated supply chains. Energy, lumber, manufacturing components, and logistics networks are closely connected. Actions affecting one side inevitably influence the other. As uncertainty persisted, delays emerged across multiple sectors. Manufacturers adjusted timelines, construction firms reassessed costs, and importers adopted a wait-and-see approach. These responses were not reactions to immediate losses, but to unclear future conditions. Markets recognized that prolonged uncertainty could generate broader economic consequences. Over time, the impact of uncertainty began shifting inward, affecting domestic economic activity. This highlighted how interconnected modern economies are, and how strategic assumptions must account for mutual dependence rather than unilateral outcomes. Part 4. Market Expectations and Adjustment. Financial markets operate on expectations as much as data. While markets are not emotional, they respond strongly to signals about future conditions. During this period, investors received mixed messages regarding policy direction, which led to adjustments in asset pricing. Equity markets declined, bond yields fluctuated, and currency movements reflected increased caution. These changes were driven less by immediate economic fundamentals and more by uncertainty about future decisions. When investors lose confidence that policy adjustments will be timely and predictable, they adopt more conservative positions. Capital tends to move away from uncertainty toward perceived stability. This process often unfolds gradually and then accelerates as expectations shift. In this case, the adjustment reflected a reassessment of risk rather than a sudden structural breakdown. One recurring feature of this period has been the use of disruption as a negotiation tactic. The underlying belief is that creating pressure and uncertainty can encourage faster concessions. While this approach may work in limited or asymmetric situations, it carries significant risks when applied to large institutional economies. Financial markets depend on signals they can evaluate and price. When policy direction becomes unpredictable, markets struggle to assess risk accurately. As uncertainty increases, investors tend to reduce exposure rather than engage. In this case, unpredictability limited flexibility instead of expanding it. Rather than producing leverage, it narrowed available options. Modern economic leverage depends less on pressure and more on adaptability, credibility, and alternatives. When uncertainty rises, those with diversified options adjust more easily. This episode highlighted how disruption can sometimes reduce negotiating space rather than expand it, particularly in interconnected economic systems. During this period, Canada adopted a stability-focused approach. Rather than escalating publicly, Canadian leadership emphasized continuity and predictability. Communication with businesses and financial markets focused on honoring agreements, maintaining supply chains, and exploring diversification where needed. The goal was not confrontation, but reassurance. For cross-border companies and international investors, this messaging reduced uncertainty. Markets respond positively when at least one party signals consistency. Clear communication helped limit speculation and stabilize expectations. This approach demonstrated how maintaining confidence can be as influential as direct negotiation. By prioritizing clarity over rhetoric, Canada reinforced its reputation as a predictable economic partner. Over time, this consistency contributed to steadier investor sentiment and reduced volatility related to Canadian assets. As market volatility increased, public discussion around economic performance intensified. Statements questioning market reactions drew attention from investors and analysts. Historically, financial markets assume that economic data and market feedback are incorporated into policy assessment. When that assumption appears uncertain, investor confidence can weaken. Markets are resilient to policy disagreements, but they are sensitive to signals that suggest uncertainty about how feedback is interpreted. At this stage, concerns shifted from specific trade measures to broader confidence in decision-making processes. This marked an important transition. What began as a policy dispute increasingly became a discussion about institutional credibility. For investors, confidence in process is often as important as outcomes. When that confidence is questioned, risk assessments change accordingly. Observers noted that responses during this period followed familiar decision-making patterns. Leadership styles often rely on strong alignment and loyalty within teams. However, complex economic systems require continuous adjustment based on new information. When feedback is interpreted defensively rather than analytically, policy flexibility can decrease. In this context, economic indicators and market signals were increasingly viewed through a political lens. Financial systems, however, respond primarily to incentives rather than narratives. When adaptation slows, economic consequences tend to compound over time. This dynamic illustrates the difference between political messaging and economic management. While messaging can influence public perception temporarily, economic systems respond consistently to measurable conditions and expectations. As market conditions affected household savings and retirement accounts, public concern grew. Economic uncertainty tends to resonate strongly with voters, regardless of political affiliation. Polling data reflected rising anxiety around inflation, savings, and long-term financial security. Lawmakers faced increasing pressure from constituents and business communities. Some advocated for resolution behind the scenes, while others adopted a cautious public stance. These differing responses contributed to slower consensus building. For markets, delayed clarity can increase uncertainty. Investors often react to indecision by adopting more conservative positions. As political discussions continued without resolution, economic uncertainty accumulated, influencing both market behavior and public sentiment. Political support from business and donor communities is closely tied to perceptions of economic stability. While controversy is often tolerated, sustained financial losses tend to shift priorities. During this period, declining market performance increased concern among major donors and corporate leaders. Some reduced public engagement, choosing caution over advocacy. This shift was less about political alignment and more about financial risk management. Capital responds quickly to uncertainty, regardless of ideology. As support became quieter, political leverage narrowed. This highlighted a broader reality. Economic confidence underpins political strength. When financial conditions weaken, maintaining broad support becomes increasingly challenging. Part 11. Legal challenges emerge. This period marked a shift as segments of the American business community chose formal legal channels to address their concerns. Trade associations and corporate groups filed lawsuits questioning the scope and application of executive economic authority. Their central argument focused on constitutional structure. Trade and taxation powers are primarily assigned to Congress. Courts treated these cases with urgency, acknowledging that prolonged uncertainty can carry significant economic costs. Rather than opposing a specific policy outcome, the legal actions emphasized predictability and process. Businesses depend on stable frameworks to plan investment and operations. Legal review in this context functioned as an institutional mechanism rather than a political confrontation. For investors, the development reinforced the idea that uncertainty was no longer limited to markets alone, but was now being addressed through formal checks within the system. Part 12. Conservative legal perspectives. An important aspect of the legal debate was the involvement of conservative legal scholars and policy experts. Many of these voices have historically emphasized limited government and clear constitutional boundaries. Their public commentary focused on precedent and long-term governance rather than short-term politics. They raised concerns about the expanded use of emergency authorities and how such tools might be applied in future administrations. These perspectives resonated across ideological lines because they centered on institutional design. For financial markets, such discussions matter because constraints and guardrails support long-term confidence. When experts highlight potential structural risks, investors take note. The debate signaled that concerns were not isolated or partisan, but rooted in broader questions about governance and institutional balance. Part 13. Institutional resilience tested. Periods of economic stress often test the strength of democratic institutions. During this episode, attention focused on whether existing checks and balances would function as intended. Investors monitored court responses, legislative engagement, and adherence to established norms. Financial markets evaluate not only economic performance, but also the reliability of systems that enforce rules. Even uncertainty about institutional outcomes can influence investment decisions. Questions about enforcement, compliance, and long-term consistency affect risk assessments. This phase prompted broader reflection on how durable economic frameworks remain under pressure. While no immediate breakdown occurred, the extended uncertainty contributed to cautious behavior across markets. Confidence depends not only on outcomes, but on the belief that processes remain intact. Part 14. International perceptions shift. Globally, investors and governments observed developments closely. Trade relationships influence international confidence, and changes in tone or direction are quickly noted. During this period, external observers adjusted expectations based on perceived consistency and clarity. Canada's emphasis on continuity and rule-based trade provided a contrasting signal that appealed to risk-averse investors. International capital tends to prioritize predictability over short-term opportunity. As a result, portfolio allocations and diplomatic assessments gradually reflected these perceptions. This adjustment was not ideological, but strategic. Trust in economic partnerships develops over time and can be sensitive to uncertainty. Once global confidence shifts, restoring it typically requires sustained stability and clear signaling across multiple policy cycles. Part 15. Inflation and economic signals. As supply chains tightened and uncertainty increased, inflation pressures resurfaced. Rising costs for energy, raw materials, and transportation affected businesses and consumers alike. Inflation is more than a metric. It influences public confidence and purchasing power. Even without monitoring bond yields, households notice higher prices, which can shape sentiment. For policymakers, rising inflation expectations reduce flexibility and add pressure on central banking institutions. Economic narratives shifted from growth to adjustment, reflecting the need to manage both markets and public perception. Financial markets interpreted these developments as signals of risk, while voters experienced tangible effects on daily expenses. This alignment of market and consumer perception emphasized the importance of stability in economic policy. Part 16. Media and market feedback. As economic indicators showed volatility, media coverage reflected the changes. Reporting increasingly focused on measurable market outcomes rather than only policy statements. Charts and data visualizations replaced abstract discussion, providing a clear view of trends. Investor sentiment is sensitive to such signals, especially when backed by data. Market reactions were compounded as uncertainty persisted, reinforcing cautious behavior among institutional and individual investors. This feedback loop illustrates how media narratives and market expectations interact. Consistent signals of risk accelerate adjustments. For analysts, The alignment of media reporting with measurable data serves as a key indicator of systemic stress and highlights the importance of credible information during periods of volatility. Part 17. Strategic constraints. The unfolding situation illustrated constraints inherent in policy decision-making. Measures intended to exert leverage may produce unintended economic consequences if the system responds differently than expected. Decision-makers face a balance between maintaining political objectives and adapting to market realities. When actions are interpreted as inflexible, market participants adjust by reallocating resources to reduce risk exposure. In this phase, the focus shifted from policy content to the interaction between policy signals and economic feedback. Markets responded to perceived rigidity, demonstrating that economic systems prioritize adaptability and predictability. Sustained uncertainty increases pressure on decision-makers to consider structural implications alongside political considerations. Part 18. Political fragmentation. Within political structures, differing perspectives emerged regarding responses to economic stress. Some policymakers emphasized caution and risk management, while others prioritized ideological or partisan considerations. Variation in messaging and internal coordination contributed to perceived uncertainty. Investors and markets are highly sensitive to unified policy signals. Fragmentation can increase risk premiums and influence capital allocation. During this period, internal differences within political parties added another layer of complexity, highlighting the interdependence between political consensus and economic stability. The episode demonstrated how divergent internal views can amplify external uncertainty, affecting both market behavior and policy implementation. Part 19. Precedent and long-term risk. A key consideration during this period was the precedent set by policy actions. If measures can disrupt markets without institutional checks, future leaders may face different incentive structures. Economic stability relies on predictable rules and enforceable frameworks. When perceived constraints appear flexible, risk assessments adjust accordingly, often leading to increased precautionary behavior by investors. Market participants evaluate both immediate outcomes and long-term implications, including structural trust in governance. The potential weakening of institutional boundaries can influence investment behavior, lending, and international perceptions. Recognizing precedent as an economic factor highlights the systemic nature of risk beyond short-term losses. Part 21. The Midterm Shadow. As midterm elections approached, economic developments began influencing both markets and public perception. Markets react continuously to uncertainty, while voters respond to tangible effects such as changes in retirement accounts, price levels, and household budgets. Historically, political instability has a stronger impact on voter behavior than ideology alone. This dynamic created a feedback loop. Market volatility increased political risk, and political uncertainty further affected investor confidence. Financial analysts and institutional investors monitored this interplay closely, pricing in potential electoral and policy outcomes. Economic turbulence during an election cycle magnifies every decision's consequences. Communication and narrative control became critical. Stability, once assumed as a baseline, shifted into the central issue influencing both market sentiment and public opinion. Observers noted that uncertainty affected not only immediate trading, but also medium-term perceptions of economic governance. The alignment of political and economic signals highlighted how closely investor confidence and public sentiment intersect during election periods. Part 22. Canada's Long Game. Canada approached the situation with a strategy focused on consistency and long-term reassurance. Rather than reacting to daily developments or escalating tensions, leadership emphasized predictability and institutional reliability. Mark Carney prioritized clear communication with markets and businesses, signaling that contracts would be honored, supply chains maintained, and diversification pursued if necessary. This approach reduced investor uncertainty and reinforced confidence in Canadian economic stability. Markets responded to the distinction between consistent policy and reactive measures, favoring the former. Over time, this strategy allowed Canada to maintain credibility without engaging in confrontational tactics. It illustrated a broader economic principle. Stability, not volume or force, underpins market confidence. By emphasizing measured responses, Canada demonstrated the advantage of patience, planning, and predictable decision-making in complex economic systems. This calm, data-driven approach ultimately strengthened its standing in investor perception. Part 23. Systems versus structure. This period highlighted the interplay between institutional structures and decision-making approaches. Modern economies depend on predictable systems, coordination, and adherence to established frameworks. When decision-making appears guided by short-term impulses rather than structural logic, markets respond quickly, adjusting risk assessments and reallocating capital. Institutions exist to ensure that no single action destabilizes the broader system. During this episode, deviations from established norms led to measurable market volatility. Trust and predictability are central to economic leadership. Once confidence in process erodes, repairing it takes significant time and sustained action. Systems can absorb errors, but are less forgiving when structural boundaries are disregarded. This phase reinforced that market confidence relies on consistent frameworks and disciplined governance rather than isolated decisions or public displays of authority. Part 24. A warning for the future. The events of this period illustrate the long-term importance of predictable governance. When decision-makers normalize disruptive or impulsive economic measures, foundational trust in markets and institutions can weaken. Capital markets rely on stability, predictable rules, enforceable contracts, and institutional checks support investment and innovation. Undermining these norms can create defensive behavior in markets, slow growth, and increase risk premiums. The costs of uncertainty accumulate gradually, often unnoticed until broader economic effects manifest. Rebuilding credibility requires long-term consistency, careful communication, and adherence to established frameworks. This episode serves as a reminder that systemic trust is fragile and must be actively maintained. Leaders, investors, and institutions share responsibility for preserving the reliability that underpins economic confidence. Stability, once disrupted, demands deliberate restoration over time. Part 25. The final verdict. Ultimately, this story reflects the centrality of credibility, institutional resilience, and predictable governance. Actions affecting economic stability are interpreted by markets and investors based on structural reliability rather than personalities. During this period, investor behavior indicated that internal unpredictability posed a greater risk than external competition. Market responses demonstrated that sustained confidence depends on adherence to process, transparency, and predictable frameworks. Once trust is disrupted, restoring it requires consistent, credible decision-making over time.